If you tried to learn price action trading and found it really hard to understand, in this video I'm going to simplify how to read and use the market structure and price action movements to help you become a more profitable trader. Let me ask you if the following situation sounds familiar. You enter a trade that it looks like a A+ setup, but the trade eventually happens to go in the opposite direction. One of the reasons is that you didn't understand market structure, and you simply didn't understand where to enter or where to exit based on the higher time frames of a market. So our first topic of discussion is learning the basic fundamentals of the market structure to avoid opening positions in the wrong side of the market and being used as liquidity for the smarter traders. The basic structure has three fundamental movements. We have an uptrend, a downtrend, and a sideways action. These are the only structures a market has, and they move in waves, as we will explain later. The uptrend is characterized by an impulsive move to the upside that creates a high. Then when we come back down, the lowest point must be higher than the low of the move before the impulsive move. This is called a higher low. Then we keep moving up, creating another higher high, comes slightly down again. This is another higher low and a higher high. So for an uptrend, we want to have constant higher highs and higher lows being created. For a downtrend, it's exactly the opposite. We have a high, we formed a lower low, then the market goes back up, but this high is lower than the previous high. This is called a lower high. Then we keep moving down, creating a lower low, back up lower high, then another lower low. So for a downtrend, we need the market to constantly break lows and form lower highs. And the final structural move is the sideways action. The sideways action is characterized by a price that repeatedly hit the same previous highs and same previous lows. Despite looking easy to trade, retail traders think that this is as easy as buying when the market hits the lows and selling when the market hits the previous high. But by doing this constantly, you might be wrongly positioned, and once momentum rises, you might get trapped in the wrong direction and lose all the profit you have made before. This market is the hardest to trade, but sideways action can be used to identify liquidity sweeps or smart money traps. Now, these simple examples look easy and are very simple to understand. These are textbook perfect examples, but on a real chart, you would see things are more complicated. This is why it is very important to watch this video, because I am going to show you how to simplify the complicated charts and understanding if we are in an uptrend, a downtrend, or a sideways action to hopefully be more often on the right side of the market. One topic traders get confused on is identifying where the liquidity sits and how to use it to understand price action. Because traders don't understand liquidity, even if you know the fundamentals of the market structure, you will not be able to properly read the chart well enough to trade on a certain market. The reason this is because you are likely going to enter on a fake out more often. The most liquidity on a market is above previous high and low of the day. Liquidity also sits in high amounts on higher time frame levels, swing highs and lows. To understand the trend, look for liquidity sweeps. Let's look at how to read price action with liquidity sweeps. So this market went up marking the first high, then it came back down, but managed to stay higher than the past low. We have an impulsive move upwards breaking the last high, so this confirms an uptrend bullish market structure leaving this demand zone behind. After forming the second high, the market usually tends to come back down for buyers to accumulate positions at a better price and push the price to the upside. By price failing to break the last high, it makes buyers less confident about this market and start selling, pushing the price down. This process repeats, and this is the psychology of the sideways market we're currently. The retail trader observes a double bottom pattern. The liquidity of the buyers usually sit below the equal lows, because it makes sense visually, but more often than not, these stop losses get hunted as liquidity sweeps. Just move the price in their initial position afterwards. Smart traders wait for price to form liquidity zones, such as a demand zone, and wait for retail traders to get stopped using their liquidity to enter a position. We know from the initial trend that this is a confirmed uptrend, so selling would only be an option if price breaks below the demand zone, which didn't happen in this situation. Instead, we broke the high as a second confirmation for the uptrend. The process repeats, marking the high, retracing back downwards, failing to break the last high, forming a double bottom pattern in which traders usually buy. Their stop losses get taken out by a liquidity sweep and price pushes up with strong momentum. If this example was confusing, you can always replay it. but it will become easier after some live chart examples you're going to see later on the video. Now onto the steps on how to trade using the market structure. The first step is to use a high time frame to observe the bigger picture. Most traders don't have patience and execute a position right away without knowing what the higher time frame communicate. Even price action concepts prioritize higher time frame moves over lower ones. The execution can be made in a lower time frame but with a confirmation of the higher time frame. The second step is to mark the previous day low and high. Because there sit many unfilled buy and sell orders, therefore are zones with the most liquidity and higher chance of increased momentum and volume, making the main direction clearer. And the third step is to look for breaks of structure and liquidity sweeps for potential entry zones. You can customize your own strategy around these zones. Make sure your system has a decent risk management. The main point is to implement market structure and price action knowledge into your own strategy. Now that we have learned the fundamentals of price action and market structure, it's time to dive into live chart examples. This is the euro-dollar chart. We first moved to the daily chart to analyze the macro situation. This market was in a downtrend, forming lower highs and lower lows. But here the trend has flipped by a change of character. The market has reversed from a downtrend to an uptrend. So now we mark the high of the day, as well as the low of the day. And we go to a lower time frame, the 1 hour time frame, in this situation. Let's analyze why this market has moved this way. In this time frame, we have the first confirmation here that this market has high probability of upside by breaking and taking sellers' liquidity. The market then slowly goes up with decreased momentum, forming higher highs and higher lows before going into a small sideways action. The sideways action has been broken to the upside by an accumulation of buy orders, confirming the following demand zone that price mitigates, goes to the upside right away, and breaks structure by breaking the previous swing high. For the entry execution, we had this following fair value gap, or the next fair value gap. The entry strategy is customizable by you, so it doesn't matter as much as recognizing the market structure. Here the same pattern happens. The equal lows have a pool of liquidity sitting below them. The market takes that liquidity with the trader's stop losses, and since we are in an uptrend, they push the price up to liquidate the past swing highs. And this happens again and again until the price creates a change of character that breaks a strong low and creates a lower entering into a downtrend. As final tips, we suggest you look for liquid markets, such as the major forex pairs, or the futures market. The more liquid a market is, the more it moves in trend. For example, let's look at the weekly NQ chart and compare it to a random crypto altcoins. Notice that it's much easier to identify the trend on a more liquid market. Better liquidity will also reduce the costs of spread and enter the price right where you place the order without additional slippage. That is it for today's video. Thank you for watching.